This section is only applicable to South Africans, and all of the data mentioned is relevant for the 2023 and 2024 tax year. It is critical that you consult with a qualified tax consultant before submitting anything to the South African Revenue Service. The aim of this section is to get you to understand the fundamentals of income tax in South Africa. Every year, the South African Revenue Service, SARS, sets the tax threshold. During the 2023 tax year, every person earning more than 91,250 Rand of taxable income in a year has to pay income tax. Companies also have to pay income tax, but in this course, we will only look at individual income tax. Below are some important terms related to income tax. Year of assessment. The tax year for an individual is from 1st of March to the 28th or 29th February each year. Normal tax consists of income tax and capital gains tax.
SARS uses two methods to collect tax from taxpayers. They are pay-as-you-earn, or PAYE, and provisional tax. PAYE obliges employers to deduct tax from their employees' salaries and pay it to SARS every month so that the employee only receives a net salary into their bank accounts. After every tax year, the employee will complete a tax return and then receive a refund if they paid too much tax after their deductions are considered, or will have to pay in additional tax if they have underpaid tax after other sources of income are considered.
Provisional tax is also not a separate tax, but a way of collecting normal income tax from self-employed individuals or salaried employees having other additional sources of income, companies, trusts, and closed corporations. To make sure the taxpayer doesn't have to pay one huge amount at the end of the tax year, the payments are spread out in two payments in advance over the tax year. Provisional tax payments are based on estimated taxable income, and the actual tax liability is then worked out after the tax year ends. Now the taxpayer then receives a refund or must pay in tax as appropriate. For individuals, provisional tax is payable at the end of August and then again at the end of February. In general, any person who receives income other than or over and above a salary is a provisional taxpayer.
Resident. It is extremely important to make sure that you research the term resident if you work abroad for large portions of the year, as you could save a lot of money on tax. South Africa has a residence-based tax system, which means residents are, subject to certain exclusions, taxed on their worldwide income, irrespective of where their income was earned. By contrast, non-residents are taxed only on their income from a South African source. We are not going to go into detail on this as it could get very complex. It is very important to consult with a qualified tax practitioner if you think you might qualify as a non-resident.
Calculation of taxable income. Your personal income tax is calculated according to the following formula. Gross income, consisting of total receipts and accruals, less receipts and accruals of a capital nature, less exempt income, less deductions and allowances, plus taxable capital gains, consisting of 40% of the sum of realized gains, less capital losses and annual exclusion, equals taxable income. Multiply tax rate according to the tax bracket, less rebates, equals tax payable. To calculate your gross income, you have to add all the various forms of income possible, like your employment income, equity compensation, business income, dividend income, interest income, and rental income. It's important to remember that certain incomes are exempt and should not be considered for income tax.
If you add all your applicable income together, less your exempt income, you will have your gross income that starts off your income tax calculation. You then have to subtract your deductions and allowables from your gross income.
Your deductions consist of your employment expenses needed to conduct your work, like business-related travel, automobile expenses, and in certain circumstances, entertainment expenses. Employees who earn most of their income in the form of commissions may, subject to certain requirements, deduct their business expenses, including home office expenses.
The deductions then also include personal deductions consisting of charitable contributions, medical expenses, and retirement fund contributions. like your retirement annuity contributions, which are very valuable for retirement planning purposes. It is important to note that all deductions are subject to certain limits and regulations. And as a general rule, allowances granted to an employee by an employer to meet business expenditure are taxable in South Africa, but only to the extent that they are not expended for business or exceed the maximum limit for deduction. Allowances to meet purely domestic or private expenditure, such as the cost of living, are taxable.
Then you add your capital gains, which is applicable whenever you sell an asset like a house or equity for more than you purchased it for. This profit is subject to capital gains tax. In 2023, the maximum effective tax rate on capital gains is 18%, and you don't pay capital gains tax on the first 40,000 Rand gain you make from the sale of assets in a financial year. All foreign capital gains realized by a South African resident are included in the South African tax net. Where an individual who is a resident in South Africa disposes of a primary residence, up to 2 million Rand of the capital gain will be exempt from capital gains tax, CGT. If the property has previously been leased or used partly for purposes of trade, an apportionment of the exclusion will apply.
Once you have added your taxable capital gains calculated, it amounts to your taxable income. The South African income tax system is progressive, and this means that a higher rate of tax applies as an individual's income increases. Therefore, you then have to identify your tax bracket according to your taxable income to calculate your tax owed. Remember, tax rates change annually.
Before you then have your tax payable amount, you first have to deduct your rebates. Your rebates consist of medical scheme rebates, all credits, and your tax rebates. All taxpayers are entitled to a tax rebate. After your tax is calculated, both these rebates are deducted from your tax you owe to reduce the final tax you need to pay to SARS.
In summary, it's important to understand personal tax so that you can consistently make better decisions regarding your tax. As mentioned before, proper tax planning is not something that one can really do when you submit your tax return. People who really save a lot on tax are those who consider the tax consequences of every transaction or investment they make. It's a continuing process, and the help of a knowledgeable tax advisor can really save you money.